Confused about the difference between a mutual fund, an index fund, and an exchange traded fund? Tanya Taylor here of Grow Your Wealth TV, and by the end of this video you will know the difference between each of these funds, but you will also know which one is best for your specific situation. For the best information about growing your wealth through saving, reducing debt, and investing, please subscribe to my channel and hit the bell to be notified when I post videos on Fridays and Sundays. So first, I want to describe what each of these investments are and their similarities and differences, and then I will talk about which one might make the most sense for your particular situation. I'm going to start by talking about mutual fund, since that one is actually the older of the three. So mutual funds have been around for about 100 years, probably a little more. And what mutual fund is that it's a diversified portfolio, and it pools the money from investors and purchases stock in various companies. Actually, it could be a combination of stocks or stocks and bond. And the benefit of mutual fund is that it's diversified, which basically means that instead of being invested in one or several individual stocks, like an investor who invests in the stock market, it's actually invested in many companies. A mutual fund can have hundreds of stocks. A mutual fund is actively managed, which basically means that it has a portfolio manager or a number of portfolio managers who try to beat the stock market index. And what that means is that, for example, if you're familiar with the S&P 500, which is a stock market index that tracks the 500 largest US stocks, what it does is that the mutual fund is going to try to outperform whatever that index returns. So let's say for 2019, the S&P 500 had a return of 10%, and this is just numbers that I'm making up. What the mutual fund would try to do is that it would try to get above that 10%, so maybe 12%, 15%, or 20%. So that's the goal of the mutual fund and the fund managers. And there are thousands of different type of mutual fund. So for example, you have the Fidelity Growth Company Mutual Fund, and that mutual fund tracks the fastest growing stocks that they expect to keep growing over the next, let's say, 3 to 5 years. And their focus is on biotech company and also technology companies. Then you have another fund like the Delaware Mid Cap Growth A Fund, and that one tracks smaller and mid-sized companies. And small companies are companies that have assets of $2 billion or less. And mid-sized companies are those with assets of $2 billion to $10 billion. So because mutual funds are actively managed, there are fees that are associated with being a part of these funds, and the fees can be up to 2%. There might be even some that the fees are higher. So you will typically hear these fees being referred to as an expense ratio. The fees, what they cover is obviously the cost for these portfolio managers who are managing the fund, but it also covers costs for the accountants, for the attorneys, and for those type of expenses. And you're going to be responsible for paying your fee annually, whether or not the mutual fund is in a gain or a loss. So let's say your mutual fund expense fee is 2%. And let's say at the beginning of the year, you invested $5,000. And at the end of the year, the value of the fund is, let's say, $4,800 because it was a bad year for the market. You would still have to pay that 2% fee regardless of the fact that the mutual fund did not have a gain. In addition to that, because the funds are actively managed, the fund manager may sell in and out within the fund. So during that same year, even though your portfolio overall had a loss, because the fund manager is selling in and out because it's trying to beat the market, let's say there was a stock that had a gain. So we're going to take, let's say Apple was in that portfolio, and Apple appreciated significantly during the course of the year. And so the fund manager sold Apple stock. Even though you got no money out of the mutual fund, because that stock was sold at a gain, at the end of the year, you will likely have to pay capital gain taxes on that mutual fund, unless, of course, your mutual fund is in your pension account and it's tax advantage. But outside of that, if it's not tax advantage, you would have to pay taxes on this gain, despite the fact that the mutual fund was at a loss at the end of the year, and despite the fact that you did not sell your mutual fund. So if that's surprising to you, please comment below and let me know. So one of your obvious questions with owning mutual fund may be, well, how do I make money if I invest in a mutual fund? And there are three ways that you can make money when you invest in a mutual fund. The first one is that you earn dividends. So all the stocks that I mentioned that are in that mutual fund, for those stocks that pay dividends, you would be entitled to a part of that dividend based on your ownership share. So you would get dividend. Also, if there are bonds in that mutual fund and there is interest paid on that bond, then you'd also get that interest payment. The bulk of how you're going to make money in a mutual fund, though, comes from the appreciation of the stocks, which means, as I mentioned before, if you had invested a certain amount at the beginning of the year and at the end of the year, instead of there being a loss, let's say instead of it being the $4,800, it was $6,000. So you would have made a gain from your $5,000 that you invested at the beginning of the year, and you had $6,000 at the end of the year, you would have a $1,000 gain. The one thing that you should know, though, is that that gain is only on paper, and you will not see any of it. You will not have to do anything with that gain until you decide that you no longer want to own the mutual fund, and then you would redeem the share. In terms of how you purchase mutual fund, you can actually purchase the mutual fund through your brokerage account or from those companies that are offering the mutual fund. So you might have a Vanguard or a Fidelity or a Schwab. They all have mutual funds, so you can purchase the mutual fund through them. A lot of mutual funds also have a minimum investment requirement. So it might say, in order to purchase my mutual fund, you have to pay $1,000 to start. And so if you have only $50, you would not be able to invest in that mutual fund. But there are also a lot of mutual funds that you don't have to pay a minimum. And one other thing to note is that once you've invested in a mutual fund, you can also just set up a recurring payment. So you know how I talk about being consistent. I talk about it in this video here about being consistent in terms of what you are investing. So that's where, like, if you don't want to go through the hassle of every month investing, you can just purchase a mutual fund and set up a recurring payment every month that comes directly out of your checking account, and the mutual fund would automatically withdraw that money and invest it for you. And what you benefit from with that too is what's called dollar cost averaging, because every month the price of the mutual fund is going to be different. So on the days when the market is down, you'll be buying more shares of the mutual fund, and obviously when the market is up, you'll be buying less share, but over time the cost is going to average out. So the key takeaway from mutual fund is that it's diversified, it's actively managed, there are fees that can be high, and you may need to pay taxes at the end of the year due to the investment managers buying and selling within the fund, even if there was an unrealized loss at the end of the year. Now we're going to jump right in and we're going to talk about index fund. But I want to remind you that if you like my content, please subscribe below, and also just let me know so far in the video what surprised you most about learning this information about mutual fund. Okay, index fund. So index fund is actually a type of mutual fund, but it's passively managed. And what that means is that it just follows an index. Whatever the S&P returns at the end of the year is just trying to match that return. Unlike mutual fund, which I mentioned was actively managed, which tries to beat that benchmark. Now, an example of an index fund would be a Fidelity S&P index fund. And essentially what it does is that it tracks the S&P 500. Index fund, because they are passively managed, they generally charge a fee that's much less than a mutual fund. So fee can be as low as 0.15%, which is what the Fidelity S&P 500 index fund charges. They also do not pay an expensive portfolio manager because they're not trying to beat the market. The thing that's also similar to the traditional mutual fund for index fund is that some of them also have a minimum investment requirement, and also you can set up the automatic payment. And lastly, this is the same for mutual fund and index fund, is that you cannot purchase these funds at any time during the day. You actually have to wait until the end of the day when the value is calculated. The value is called the net asset value. So when they've finished valuing the asset at the end of the day, that's when you could purchase or sell your mutual fund and index fund, and that's really only done once per day. Okay, so I have covered mutual fund and I have covered index fund. Now I want to talk about exchange traded funds. Exchange traded funds are similar to both mutual fund and index funds in that they are diversified, right? However, they're more similar to index fund in the sense that they have lower fees because they are also passively managed. The big distinction with exchange traded fund from the other two is that they trade like a stock, which means that on any given day, you can go into your brokerage account and you can purchase an ETF the same way that you would purchase a stock. As a result, there is really no minimum investment per se, as you would just be purchasing a share. So for example, if you wanted to purchase an ETF and it was $100 and you only had $100, you could just go and spend that $100. Whereas for some mutual fund, if you only had $100 and they have a minimum investment requirement, you would not be able to invest in that mutual fund or in that index fund for that matter. So based on what I've discussed so far, you know that all three types of investment have a diversified portfolio, which means that your risk is spread across a number of different assets. You also learn that mutual funds and index funds are pretty similar, except that mutual fund is actively managed and index fund is passively managed and has higher fees, while index funds and ETFs have much lower fees because they are passively managed. I would love for you to comment below and tell me if there is anything that you found surprising about these three different type of funds, and also if you are invested in any of these type of funds. Now the next thing that I want to talk about is which one is right for you. So you've heard about these three. They have certain distinct differences and they have many similarities, but which one should you invest in? And the way that you want to think about it is you would choose an ETF if you wanted more favorable tax treatment and if you're fine going on a monthly basis to invest in your account, in your brokerage account. And also if you need something that's more liquid, where if you wanted to just go in and sell it right away, you would be able to do that right away. So an ETF would be best for that. An index fund would be great for the lower fees, but because it only gets valued on a daily basis at the end of the day, it would not be as easy to get your money if you need it. It really is not totally difficult. It takes a short period of time, but it's just not as easy as going into your account and clicking the button and selling your ETF. In terms of lower fees, though, it's definitely lower than the mutual fund. So the way you want to think about it then is if you want to invest in, let's say, a mutual fund or an index fund because of the recurring monthly payment. Let's say you're like, you know what, I just want to set up a monthly payment every month and I want them to take the money out of my account. I don't want to have to think about it. So you would be making a decision between a mutual fund and the index fund. And the things that you'd want to think about on that is that for the index fund, it's only going to, your return is only going to be as high as the market that it's tracking. So if it's tracking the S&P and the S&P returns 10%, then all you're going to get at the end of the year is likely right around 10%. Whereas for the mutual fund, what you would think about is if you really believe this fund has been performing well over a long period of time and you believe that you could get more than 10%, but that's where you would say, okay, maybe I would invest in the mutual fund instead. But you also have to consider a couple things for the mutual fund. There is that fee that I talked about, which could be 2%. Sometimes it's a little bit less. You also have to remember that you would be paying taxes if your mutual fund is not in a tax advantage account. And lastly, is that if because the investment managers are trying to beat the market, it's possible that in any given year your return might be low. Now, you can look at the history of the mutual fund over a longer period of time, and you can think about what is your investment objective. And if you see a mutual fund and you're like, with the fees, with the taxes at the end of the year, I am still getting a, let's say, a 20% return. I'm making up this number. You can say, okay, well, I am okay with investing in a mutual fund because I believe that over the longer term, I am going to be able to get a better return than an ETF and a better return than an index fund. So that's how you would want to look at it, but you want to make sure that you're thinking about all of the distinct components within each of these different funds and what purpose you need it for. I'm not a huge fan of mutual fund, but I think that it does serve its purpose. And if there is a good fund manager who has been managing the mutual fund over a long period of time and they've been providing really good return, and there is no really big reason for someone to say, okay, I'm not going to invest in the mutual fund. One other thing that I would want to caution you about a mutual fund as well, though, is that fund managers do change, and a new fund manager could come in and have a slightly different philosophy about how to invest, or also he or she might come in and the returns on the mutual fund is not as great as it used to be. So you would also just want to be mindful and keep track of your mutual fund to make sure that there isn't really any big changes. You can find out about like what the funds invest in and also their largest holdings and the fees that they charge by just going to the website of the fund that is being offered. So let's say a Vanguard is offering a fund. You can go onto Vanguard's site, you can look up this fund, and you can also just do a Google search of it, to be quite frank, and it will tell you the details of these funds so that you can get more information. So now that you've learned the key differences between mutual fund, index fund, and exchange traded fund, I would love to know which one suits your investing approach and your strategy. I also want to let you know that I do have a free ebook, which you can download from my website, and that's how to build your personal wealth roadmap and some of the components that you want to think about as you're building that roadmap. You can also hop over and join my Facebook group where I have other discussions about other types of investment. And of course, please like and subscribe and share this video if you found it helpful.